Hello, my name's Rob Nixon. I'm the CEO and founder of the Proactive Accountants Network. We're a global network of accounting firms, and what I like to do is to pick on the high performers. Insofar as, what are you doing there, what are you doing there, let's roll it out to the rest. So this 12-part series is about that, a summary of some of the great ideas we've picked up about driving your revenue, your profitability, and your cash flow. So part 4 is all about your realization margin, or your write-ups or write-downs. So let's say, for example, how this is measured. You put 100 hours on the clock as far as doing work, but then you decide, oh, we can't charge that much, let's take 12% off, so you have 88%. I'd prefer that's measured in minus 12, not 88, because 88 makes you think, oh, we're actually pretty good. This is complete wastage. It is discounting before billing. Anything to do with write-downs is waste. And not only that, it's a bad habit where you made a decision to do it many years ago. So to fix it, because you should be aiming for plus, as in 100% or more as far for realization rate. Our top performers are getting 40, 50% write up or 140, 150% realization rate. But you can't do this if you price in arrears. You can't do it unless you make a different decision. You decided to write down, so now you decide to write up. But you must only write up if you've priced up front. You see, when you price up front, instead of pricing arrears, you price the job at $5,000, now you're incentivized to have less time on the clock. In arrears, you're incentivized to have as much time on the clock. I think that's actually unethical. Poor old client pays more than they actually should. So you're not incentivized to be as efficient as possible on a price and arrears model. So price every job up front, you make a decision. What we're going to do here is take the labor out of the job, stop over-engineering jobs. We're going to have an hour's budget on job, where we're going to drive the time down, and we're going to put all that time on the clock to see what our real number is. You know, the interesting thing, as I survey professional accountants, before we get to the write-downs, I say to them, so how much time do you put on the clock for the work that you've actually done? This is before write-downs. And the consensus is about 80 to 85% of the time they actually do gets put on the clock in the first place. And then it's written off another 10% or so. So this is ludicrous. You are wasting money, and you have people who are not billable, and it's just clear profit. You know, some firms, when it comes to write-downs, they're big numbers. You know, they're literally tearing up hundreds and hundreds of thousands of dollars of revenue profit every single year. They're burning. You know, you see a picture of a house, and the house might be worth $500,000, and firms are tearing it up every year. You get more enjoyment if you burnt that house every single year. That's what you're doing. You're burning houses, apartments, expensive motor cars every year, and you don't need to do so. All you have to do, make a decision not to do that anymore. You price every job up front, you put all time on the clock, and you take the time out. Very, very critical to stop this bad habit, this demoralizing habit of write-downs. Aim for a plus. This is one of many, many strategies in our strategy map of 488 key projects. Send us an email to report@proactiveaccountants.net. We'll send you a copy of the strategy map, and we'll send you the white paper about revenue, profit, and cash in a successful accounting business.